Our session focuses on the European monetary policy response by the ECB. Philip Lane is the ECB's chief economist and member of the executive board and a former economics professor. Philip, the floor is yours.
Thank you for the introduction. It's a pleasure to take part. Okay, so what I want to do is try and go over the current situation a little bit in terms of retrospect and then prospectively in terms of the monetary policy challenges facing the ECB. So this is one way to capture the scale of the shock this year. So the left panel shows you what happened in the first 3 quarters of the 08-09 financial crisis. And of course, that was a very large shock in terms of the disruption to economic activity. The right panel shows you what happened in the first half of this year. So in terms of scale, I'm not going to say it's off the charts because it's on the same chart scale, but it's nearly off the charts, the decline in output. And also maybe a very big difference is in relative terms, it's very much hitting the services sector relatively more than manufacturing, which again is not the shock we had in 08-09. And of course, that's immediately consequential for many topics. So that brought you through quarter 2, which is the black line in this chart, which is the realization of output. And then this is from our September projections. From the point of view of the bottom in quarter 2, we have had a sharpish recovery in quarter 3. We think about half of the decline in output has been reversed through basically the bounce back effect. The blue line is our baseline and the others are the scenarios. We also think the recovery will continue, but you can see the slope is quite different in quarter 4. And by the end of quarter 4, 2/3 of the decline will have been reversed, but still running at 95 compared to pre-pandemic 100. That 5 percentage point gap is pretty big in terms of a business cycle gap. And what we are modeling is that then that's a gradual elimination of that over 21 and into 22. And, of course, that's conditional on the course of the pandemic. That baseline is essentially assuming that there will be medical solutions by mid-21 and a general rollout, by the end of 21. So whether that's a vaccine or just really good treatments, something is going to allow the European economy to operate with greater confidence and fewer restrictions. And of course, it's obvious there's a lot of uncertainty around that. And then the consequence for inflation, maybe there's 2 messages coming out of this. One is the fact that, given that the starting point was inflation around 1, given that really big shock to output, it's not surprising that directionally the inflation rate has dropped. And we are showing here the inflation rate, below 0 for the last part of this year. So that's one message. But equally, the message is there's going to be, given that we are expecting or are in the middle of a fairly sharp turnaround, that will also apply to inflation. The gap, the output gap is going to be a lot smaller a year from now than it is now. So we do have, under the baseline again, a recovery by the middle of next year back to that kind of 1% zone. And we do think in the same way we expected inflation not to be stuck at 1% going into this year, we do expect the inflation momentum to continue to build. But, over this horizon, it's still under the baseline going to average in 2022 1.3, which is far below where we would like it to be. So what this graph or page is trying to tell you is behind all of that, of course, policy making was not quiet. There's a lot of fiscal action, but also the ECB was busy through different elements. Part of what's shown here is some of the engineering elements of monetary policy, like collateral measures, some of the supervisory measures on the SSM side of the ECB. But from my point of view, what I can talk about more is how we responded in terms of asset purchases, the PEPP, and how we responded in terms of targeted lending to protect the credit supply. Now, one thing that's worth mentioning, because this is not something we actually had to actively do, because going into this crisis, our monetary policy, the forward guidance on the monetary policy, had already, if you like, conditioned future interest rates and future of the asset purchase program to the inflation outlook. And what we've seen here is, given the trajectory in these months, is there's been a big movement in the EONIA forward curve, because the market has calculated that given the inflation dynamics we face, the kind of data at which we're likely to start raising the key policy rates has moved out quite a bit. So there's quite a big pause in the the time at which we're going to tighten policy. So that was basically an example where our existing monetary policy framework delivered quite a lot of easing in terms of the kind of OIS yield curve. But of course, we all know for the euro area, it's very important for financing conditions across the euro area is what's going on with sovereign yields. What this graph shows you is the bottom line, which is essentially over this year, if you compare pre-pandemic to now, we've basically either stabilized or slightly lowered the average yield curve, on a GDP-weighted basis. Dwelling on that a little bit, of course, this is where the APP has played a role and the PEPP has played a role. This is descriptively the time series behind, where I take the 10-year rate as a representative rate, an important rate. And what you see is the initial impact back in March and in April was basically two waves of increasing yields. The first wave was kind of undone by the announcement of the PEPP. That's the dramatic bit in the middle. But then after a few weeks, the average yield started to climb again, because there was a lot of concern about the future challenges facing various governments. And what we've seen since late April until now is a trend down in the yield curve. So that's, in part, of course, we've expanded PEPP, PEPP is working and so on. But clearly, there's also a role for our collateral policies and clearly for the various fiscal initiatives. So the demonstration that tail risk facing Europe would find a response, for example, through the recovery fund and, country by country, all sorts of individual events also. So I think that this is a very important feature. And you can see, if you like, when you kind of have that decomposition, that, the OIS contribution has contributed to the easing of conditions. So if you want to think of it like that the OIS contribution has, eased policy, but also you see in terms of the average yield curve that they're very strong narrowing in spreads, and that's really been a big feature of this year, and it's ongoing. Now, behaviorally, it's important to recognize some of the elements of what was going on there. So if you divide, or if you find two subgroups within the euro area of less vulnerable, the countries like Germany, Netherlands, France, the core, if you like, to use one phrase. And then the more vulnerable countries, which here are grouped together, Italy, Greece, Portugal, and Spain. I think you can learn a lot from the balance of payments. And of course, unfortunately, learn this with a lag. But even in real time, I think you could feel this if you were day by day looking at what was going on. And then let's focus on the liability side. On the liability side, the orange boxes are debt liabilities. And what you saw in March and really throughout those first months of the pandemic is basically a strong inflow into the government debt markets of the less vulnerable countries. So this is the flight to safety. These are the safe assets for the euro area, and there's definitely that flight to safety was going on. But the flip side of that was there was a net selling of the sovereign debt of the more vulnerable countries, which is pretty strong in March, ongoing in April, and since then it's either been eliminated or slightly reversed. And so this is exactly, one of the core points of the PEPP is to recognize when you have a common currency, the kind of elasticity of capital flows to risk is different because you can move across borders without taking on currency risk. And, I think one of the intended contributions of the PEPP through its flexibility was to signal that this flight of safety should not have a self-fulfilling component where people are running because there's a fear others will run and there's no stabilizing force. Now, behind that is also useful, I think we can learn a lot by also thinking about, well, who are the holders of debt in the euro area and how do we think about their behavior? Because, of course, we know from many previous crises, different types of intermediary have different balance sheets, they have different short-term, long-term mixes, they have different stickiness of their liabilities. And so this goes back to the end of 2019, just as a pre-pandemic baseline, and you can see the mix across the different intermediaries where, for banks, you have banks, you have insurance companies, pension funds, and so on, playing a role. And of course, there's also indirect holdings through mutual funds and so on. And what we see is both for the less vulnerable countries and the more vulnerable countries, something that I think was true in previous cycles, which is the banking system played a stabilizing role. So the banking system were net purchases in both categories, both for the less vulnerable and the more vulnerable countries. The banking system was a net source of demand, which is, a stabilizing pattern. Whereas investment funds were net sellers, insurance companies in the less vulnerable countries, by the way, were net sellers as well. So there's an interesting, I'm a fan of thinking about the composition of the investor base in these situations. Okay, so then when we go to the PEPP has always, from word go, had a dual function. It's regular QE, it's regular monetary policy, it's ongoing now, part of the way we control the yield curve or push down the yield curve. But there's also, in the same way the Fed had a stabilization role in the US, the Bank of England in the UK, etc. There was also the importance of being a stabilizing force in the debt markets. And I think it's universal across central banks. What we've seen is, if you like, as the markets have stabilized, the kind of front-loading pattern need not persist. So you can see in the full months in April, May, and June, there's a lot of front-loading of the purchases, and that has come down because essentially with this, stabilization of yields and so on, the rotation, if you like, has been from the stabilization imperative to more the monetary policy stance, where a steady monthly rate of purchase, is fine. It's a natural way to allocate the PEPP allocation. And then the right panel shows you from our public releases the geographical composition of the PEPP. The way I presented it here, it's really intended to highlight two things. I mean, again, we said from word go that the capital key is the baseline. If you step back from that graph, you might say that it looks pretty stable, the geographical composition. But then if you zoom in, you do see a degree of geographical variation where over time the deviations from capital key become smaller, essentially because the stresses on individual sovereign debt markets have become less. Okay, next slide. I won't say too much about TLTROs, but we do think, worked quite successfully. The design of it, I think, meant that the take-up has been widespread across the area. It's clearly area-wide program, and we are confident that a lot of it will be passed through into greater credit to firms and households. Lending rates have been stable. There's a decomposition here between the different components. The lending rate has been stable. At the bottom of that, you see this blue contribution. I mean, that's in part a cheap TLTRO funding. The cheap TLTRO funding, in terms of the overall blended funding cost, is to some extent offsetting of the rising credit risk and so on. Now, the fact that lending rates have been stable and lending volumes have been maintained, of course, also heavily depends on the state credit guarantees that have been in many countries. That's essentially a backwards-looking review or a point-in-time review. And the way I try and think about what's next is to use this graphical device, where pre-pandemic we were on the path A to D, where pi star here is the inflation aim, whatever that is, and A was our starting point at the end of 2019. And you might imagine the general strategy was over some time period, we would gradually bring inflation up to the inflation target. Then when the pandemic hit, if you like, there was this downward shift, shock to inflation, which we saw earlier on in the data, which you can think of it as a jump from A to B, that there was this negative inflation pressure. And then the question is, okay, how do you respond to that shock? One strategy is captured by the orange line B to E, which is basically say, okay, we've been knocked back, but let's just take a gradual approach. Let's get to inflation aim. It's going to take longer because the starting point is lower, but let's basically maintain that gradualist approach. The risks of that are, of course, a long time far away from the inflation aim may be anchor inflation expectations. Second, very low inflation rates for a long time are equivalent to high real rates, which of course would slow down the recovery. So the strategy is essentially to have an intense phase of extra QE, have a high rate of asset purchasing under the PEPP in order to boost inflation back towards the original path. So the original path was, A to D, which, if you like, at the end of 22 had a value of 1.6. So if you like, having an intermediate objective of saying, well, let's get somewhere in the neighborhood of that, have a intense phase to eliminate the negative inflation shock. So that's stage one. And stage two is even if you get to 1.6, within the projection horizon, some neighborhood of that, of course, that's still below close to 2, and you still have the ongoing challenge even after the pandemic shock is hit of closing the gap with inflation aim. Maybe in just finishing, I just want to make one point, and this is more to try and outsource some thinking to the economists in this WebEx. It is essentially to remind everyone of something we all know, which is the euro area is quite an open economy. The euro area has a lot of success in exporting, and of course over time the rest of the world is increasingly important because China has grown, the emerging world has grown. So the share of world GDP, this is a good news for the euro area. There's a lot of customers out there, but we do have to take into account this open economy dimension. What's interesting about the history of the euro area over the last 20 years is this shift in the last decade towards an aggregate and fairly large current account surplus. So before the crisis, we had more or less around zero because the surplus countries were counterbalanced by deficit countries. Whereas since then, of course, there's no significant deficit countries, and so we have a pretty big surplus, chronic surplus. So why does that matter for monetary policy and inflation? What you see here is this fairly strong empirical correlation that the inflation rate and the trade balance have a significant pairwise correlation. But by the way, if you put this into a multivariate regression, it still shows up that there's a significant coefficient on the trade balance in explaining inflation in the euro area. And one way to think about this is really that there's two ways to have a high rate of economic activity. So if you kind of close the asset gap by selling to the world, by exporting, that can be very good for employment. Can be very good for in terms of getting the economy to maximum employment. But it doesn't necessarily create the domestic demand conditions which create inflationary pressure. So this is a conjecture I carry around with me, which is it'd be interesting to know if you had the same unemployment rate with a much smaller current account surplus, would pricing pressure be stronger in the euro area? I mean, what goes behind this is that if you think about European firms, would they be more likely, more confident in raising prices facing domestic consumers than they are facing global consumers? And that's really just a conjecture to stimulate a discussion. But let me stop there.